Hi, good morning, everybody. My name is Sailesh Jha. I'm with RHB Group, and I'm Group Chief Economist and Head of Financial Market Research. I'm here to present to you our 2023 outlook for global markets and economics. And the three key messages I'd like to leave you with are that some of the very negative sentiment among investors about a U.S. a global recession coming. We think that essentially those fears are overdone, and that essentially we are bullish on the outlook for financial markets and the economy in 2023. This means that in terms of your portfolio, the asset allocation from our perspective is to be overweight equities, market weight fixed income, and underweight cash. Some U.S. equity markets, you'll find this quite interesting. We're counter consensus that are early stages of a bull market. Specifically, the Dow Jones Industrial Average Index, we think it's going to go up by around 10 to 15% in 2023. In terms of the dollar, just to let you know, we've been dollar bulls since December 2020, and now we are essentially turning less constructive on the dollar. We think peak dollar strength is behind us, particularly against Asian currencies. We get a little bit more appreciation of the dollar against Asian currencies in the first quarter, but the worst in terms of Asian currency depreciation against the US dollar is behind us. And Asian currencies, the good news is, will appreciate against the dollar from the second quarter to the fourth quarter of 2023. Besides equities, U.S. equities, we like also India. We continue to think to buy India on dips and sell China on rallies. And we believe that this part of the world, our home base, Southeast Asia, will remain fairly resilient in the equity world in 2023. In fixed income, given that overnight the Fed has guided exactly to what we thought they would guide, that the peak federal funds rate is 5 to 5.25%. Their number is 5.1%, bang in the middle of what we are expecting for the peak federal funds rate. We basically advocate, scaling into or selecting long duration government bonds in the U.S. and Southeast Asia. In some credit markets around the world, we like essentially U.S. Credit, particularly high yield bonds relative to emerging market credit high yield bonds, simply because the emerging markets as an asset class is going to be contaminated by continued negative sentiment from China, which affects the entire emerging market spectrum. The average returns in fixed income still pretty good, high single digits relative to, let's say, the Dow Jones Industrial average of around 10 to 15%. So what that means is the asset allocation is as such where overweight means you get relatively higher returns than market weight. That's how we explain it. So let me just illustrate a few things. If you look at the charts that my colleague has kindly put forth in front of you, you'll see in figure one how bad the sentiment is in terms of investor sentiment, as indicated by the blue line. This is essentially the 6 month ahead expectation of what global investors are thinking about the outlook for global growth, and it's clearly collapsing. Okay. At the same time, the funny thing is that if you look at the momentum of global industrial production in the red line, you will notice that growth is already starting to recover. So our base case is that yes, U.S. and global growth, including our part of the world, will decelerate in terms of growth, but to trend right growth rates rather than any collapse or any sort of a recession. And we'll see a recovery in the second half of the year in terms of global and Asia economic growth. What that means is, generally speaking, one of the factors that we look at when we think about the currency, about the dollar, or some people call it the greenback, as represented by the DXY index in figure two, is that in pretty good growth environment where U.S. growth is recovering, where global growth is recovering as well, the dollar has a tendency to depreciate against Asian currencies. And that's what we're forecasting. If you look at our forecast, essentially we are looking for a modest depreciation of the dollar, and particularly against Asian currencies from the second quarter to fourth quarter of next year. So, financial markets have been looking for this recession for quite some time to come in 2023. Now, essentially, analysts are looking at a recession sometime in 2023 or 2024, right? Our base case all the way through from summer of 2022 has been that the US is unlikely to head into a recession in 2022 and 2023. And so we're maintaining our GDP growth forecast for the US at 2.2% and 2% respectively for 2022 and 2023. Whereas essentially the Bloomberg consensus estimate for this year is 1.8%, next year 0.4%. So you can see that our view on US growth is much stronger than what analysts are in fact expecting. So the key reasons are basically given in detail in our October 5 report, US growth is made in Asia, limited signs of a recession. I'll just walk you through the bare bones of the view. The view is the following, that in terms of the tightening of monetary policy by the Fed, we think that much of it has already impacted the US economy and global economy in the first half of the year, first half of 2022, keeping in mind that the U.S. economy actually went into two successive quarters of negative growth, or essentially contraction, already in the first half of 2022. So one of the reasons why we're so optimistic on the world and are bullish on equity markets is that our forecast on U.S. growth for next year and this year is much higher than the Bloomberg consensus estimate. For this year, we're at 2.2% versus the Bloomberg consensus estimate of 1.8%. And for next year, we're at 2% versus the Bloomberg consensus estimate of 0.4%. It is nearly impossible to generate this year's growth of 1.8% per what analysts are expecting, because you would need essentially a very pace of growth in the fourth quarter of 0.2%, where we think that the fourth quarter GDP in the US will surprise massively on the upside at 1.4 to 1.9%. The bottom line is that heading into 2023, the momentum of US growth and its impact on global economic growth is very strong. So next year we're at 2% versus the Bloomberg consensus estimate of 0.4%. And that is all given in our basically very counter consensus report published on October 5, 2022. US growth is made in Asia, limited signs of recession. The main reasons why we're bullish on US and global growth with a recovery in sight in the second half of 2023 is a couple of reasons. One is that the tightening of monetary policy by the US central bank and major global central banks has already impacted US and global economic growth in the first half of last year. Just to give you some color, the United States actually went into a technical recession, which is two successive quarters of contractions of growth in the first half of next year, and global industrial production collapsed in the first half of next year. And so what we think is the lead lag impact or timing of the impact of monetary policy on growth is essentially 3 to 6 months, rather than what many analysts and central banks think is 12 to 18 months. And so the remaining part of the Fed and global tightening cycle will be essentially felt in the first half of next year, and we see a deceleration, just a trend, not to some sort of a recession in the first half of next year. Second half of next year, as basically many central banks around the world start pausing, taking their foot off of the accelerator on policy interest rate hikes, US and global economic growth will recover. At the same time, the good news is that we are well past the peak of inflation in the US, we will be approaching the peak of inflation in Europe in the first half of next year. And in our part of the world, we are close to I think, much of the price pressures in Asia with regards to inflation is basically mostly behind us. So what that means is last year's key concern of inflation and monetary policy tightening is last year's story. So what is the market? What are markets going to look at for 2023? Three main themes. The first is the outlook for U.S. and global growth, and there, our key message to all of you is that investors are too bearish and they will basically turn to the RHB group view of becoming constructive in the first half of 2023. That, from an asset class perspective, pretty good growth next year, declining inflation, pausing of monetary policy is a perfect environment to be bullish on equities. In terms of the path of the U.S. dollar, if global growth and U.S. growth is up, U.S. Fed policy is going to start looking like it's peaking in the first quarter of next year at 5 to 5.25%. Limited geopolitical risk, which will impact market sentiment, is an environment where the dollar will start depreciating for much of next year. A little bit dollar strength in the first quarter, but those would be the opportunities we would look to essentially sell the dollar and buy Asian currencies. Keep in mind that we were one of the first people in the market to be dollar bulls starting in what seems like an eternity ago, December 2020. So we are now basically turning in terms of our view. The third theme that markets will be looking at is essentially the China reopening story. And we think that there's a lot of uncertainty out there. And so as far as China goes, a lot of people are starting to think in the market that maybe China's at the turn in terms of financial markets. But we think basically it's a sell on rallies. So if we look at the first investment theme, in terms of U.S. growth, again, the broad details are the following, and how do we position for that, outperform, basically upside surprise in U.S. growth, is that the global asset allocation then means that we're overweight equities, market rate fixed income, and underweight cash. The Dow Jones Industrial Index, we like it. It's our top pick in global equity markets. We think that the Dow Jones Industrial Index is at the start of a bull market, and that it'll give you returns of 10 to 15% next year. The other markets that we like are India, we like Southeast Asia. We basically think that China is a sell on rallies. The main reasons for our positiveness on U.S. growth, which propels, keep in mind that the U.S. is the center of the world in terms of catalysts for global economic activity. So we have to understand, why are we so bullish and why is the market completely wrong? One is that, as I mentioned earlier, much of the impact of tightening of monetary policy is close to behind us. The full impact or remaining impact will be felt in the second half of next year. Two, that inflation, the peak of inflation is behind us. Three, that consumer and corporate balance sheets in the United States are very strong coming into this slowdown period. So the message that I'd like to give you beyond just next year is that we are in the process of adjustment back to the old world, which is a Goldilocks type of environment. Resilient growth, trend growth, stable inflation, much like what we had prior to COVID-19, which started in 2019. And that there's a 50-50 probability that global economic and policy conditions over the next couple of years are going to return to where we come from. We don't see any sort of structural break, which means that from an asset allocation perspective, it's extremely difficult to be negative on equities or even fixed income. So it is a great environment to be invested in risky assets. Now, the second investment theme, which is important to understand, is the path of the U.S. dollar. Now, generally speaking, if the dollar is appreciating big time, it's a problem for the world, particularly if the dollar is appreciating big time against emerging market currencies. What that does is create a whole host of financial market and economic instabilities, which is not good for the world as a whole, and essentially means that it's extremely difficult for risky asset prices to be on a sustained uptrend. The good news is that given that what we're seeing from our model results, that what matters for the dollar really is the trajectory of the Dow Jones Industrial Average Index, the inflation differential between the U.S. And developing markets, as well as the interest rate differential between the U.S. and developed markets, to name a few, are mostly pointing towards the idea that the dollar from the second quarter to fourth quarter of next year will depreciate against Asian currencies and against many emerging market currencies. So that gives you further comfort that some of the financial market economic instabilities that emerging markets realized in 2022 will start dissipating in 2023. From a currency perspective, which are the currencies that we think will be the biggest beneficiaries of dollar weakness, is essentially the yen, which has been of such a big concern for global investors when we started trading up to 1.4 yen, started trading up to 145 or so. We think essentially that the dollar yen is going to fall to 128 to 131 by the end of 2023. The last main theme, in the interest of time, I'd like to focus on is China, the China reopening. For us, the key message is we remain short China and long India. The Indian stock and bond market has outperformed the Chinese equity and market, just not in recent years, but for roughly the last 8 to 10 years. The problems in China in terms of reopening are going to continue because we just don't know how serious the COVID-19 problem is out there. Secondly, keep in mind that although there was a little bit of thawing of the ice between the U.S. and China recently, with some happy handshakes happening between President Biden and President Xi, that's temporary. We think basically those conflicts or issues, geopolitical issues between China and as well as Western alliance and China will continue to go up. The U.S. will continue to ensure or want to ensure that China's role in the global economy and financial markets doesn't escalate further. The technology and financial sectors will continue to be under pressure in China from the U.S. The geopolitical tensions between the U.S. and China are only going to go up. On the domestic front, the policy intent to rein in the ultra high net worth individuals, let's say, wealth portfolio is going to continue, and growth is going to surprise on the downside, where we think that GDP growth next year is going to be in China at 4% versus the consensus estimate of around 4.8%. Technically speaking, the real, meaning the official number could print around 4%, but it's more likely that the true GDP next year in China will be essentially, 1 to 1.5 percentage points lower than that. So that means roughly around 2.5% GDP growth to sustain the Chinese economy and its population. Just to sustain them, to feed them properly, you need 3% growth. So we think social instability type of risk are picking up in China. So let me leave you with our three key messages for 2023. It would always useful to think about what the consensus is suggesting and what is the reality. So that's why the name of this publication is Separate Pathfinder, Separate the Noise from Reality, and what the consensus estimates on U.S. growth is purely noise and herding behavior. It doesn't pay to be out of consensus in financial markets, and that's one main message. So don't worry, we are in for a second half recovery in U.S. and global growth. This is going to be very good for risky asset prices. So our global asset allocation is overweight equities, market weight fixed income, and underweight cash. We like the U.S. Look for returns in the Dow Jones Industrial Average of 10 to 15%. Fixed income, we advocate buying long duration government bonds. And in terms of currency world, we are peak dollar strength, a little bit more strength in the first quarter of next year, but second quarter to fourth quarter of next year, the dollar will depreciate against Asian currencies. That's it from the RHB Group front. Thank you, everybody, for watching this podcast. And my humble request is that at 8 a.m. every day of the week, please join us on the Morning Cuppa, where our analysts will brief you on the outlook for financial markets and economies around the world. Thank you.